Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. We are ending the Friday or closer to ending the week on a negative note. It is a 210-point cut that we're looking at the Nifty. There was a wee bit of a recovery, but that again seems to be getting sold into across the board. There is a big pressure that is coming by. Nifty Pharma is the only one which is in the green right now. We, of course, have Cipla's US sales number which has come by, which is higher than what the CNBC-TV18 poll was suggesting as well, between $218 to $221 million. The stock is spiked to the day's high. We'll, of course, get Winnie in just a bit to decode those numbers for us as well. But while we talk about mid-caps which are taking a bigger hit, overall, a lot of stocks which are reacting to positive earnings, be it Sharda Cropchem just reported numbers, Tattvachintan Pharma up 16% after numbers reported yesterday. We do have a lot of these names in the pharma space which are doing well as well. So a lot to talk about.
That's right. Good afternoon, Sonal. Quite a lot lined up on the show. In fact, Hormuz has neatly compiled a whole host of list of stocks, the broader end of the market that are making all the moves. Hormuz, I'm assuming most of them are dominated by results impact.
Oh, yes, they are. And that has been the case, right? Good earnings are getting rewarded, but the bad earnings are getting really, really punished. And we start off with the result. Look at the negative reactions there. Intellect Design Arena just reported results 6% lower here. HFCL as well, a loss compared to a profit last year. So 4% lower on that stock. UTI AMC and KFin Tech, both numbers came out yesterday. They too are seeing knocks in today's session of up to 5.5% each. Positive earnings reactions, though, you mentioned Tattvachintan Pharma, 16% higher still. Phoenix Mills, after the upgrade that came in from HSBC, both Anantraj and E-Clerks are off the highs of the day, but Solara just reported numbers that has seen a very sharp spike in today's session after the results. The newsmakers dominated, of course, by IEX. Of course, the reversal that we have seen after the pummeling that it took yesterday. Sona BLW is at the lows of the day, as is APL Apollo Tubes after cutting its volume growth guidance for the full year. Stocks that are doing well and not so well on the volumes front. Trident is an earnings reaction. Metro Brands, of course, a beneficiary of the India-UK FTA, and Ajmera Realty too, 4.5% higher after strong numbers yesterday and doing well on strong volumes. And lastly, he spoke about pharma names. They continue to do well. It's Syngene at the highs of the day, Torrent Pharma at the highs of the day, and Mankind Pharma too ahead of results, reaching towards the day's highest point. Back to you guys.
Well, thank you so much for that, Hormuz, for joining us and taking us through all of the stocks that are moving around in the session. Well, a couple of stocks. Have a look at APL Apollo Tubes. That particular stock came out with its results closer to market close last evening. A guidance cut over there, and APL Apollo Tubes now trending near the day's lowest point. But with that, we'll slip into a short break. We'll get you more on the markets and corporate conversations on the other side.
Welcome back. You're still tuned into Mid-Cap Radar. KFin Technologies reported a weak set of Q1 number. Revenue has dipped for the second straight quarter. Margins also are under pressure. We are joined by Srikanth Nadella, who is the MD and CEO at KFin Technologies, joining us now. Srikanth, good afternoon. Thank you so much for joining in. But it's the second consecutive quarter of revenue fall that we've seen. It's driven by issuer solutions, international and other investor solutions. The domestic MF business has grown 3% sequentially. What is the outlook going ahead? Do you maintain your guidance that you had shared earlier, 18 to 20% growth in FY26?
Thank you so very much, and good afternoon to one and all. Our line of business always tracks to year-on-year growth and not so much on quarter-on-quarter growth. It's financial services. Typically, in our line of business, Q2, Q3, Q4, are always far more aggressive in terms of the growth as compared to the Q1. So we have seen a good growth in the context of some headwinds that we have seen overall in the markets in the month of April. Markets have picked up subsequently. But an overall revenue growth, over 15.5% and a PAT growth of over 13.5%. August, basically is an indication of a good season ahead of us. If you look at FY25 and FY24 too, the trend is pretty similar, which is basically a Q1 start with a PAT margin of close to about 30%, EBITDA about 41 to 42%. Which eventually means it will, probably end up anywhere around 43 to 45%, which is pretty much in the line of the guidance that we have.
So you're sticking to your guidance, all of the guidance, earlier revenue guidance you had given in the range of 18 to 20%. The other question is, we want to understand from you, as far as the mutual fund revenue yield is concerned, it's actually dipped on a sequential as well as on a year-on-year basis. What is the reason for that, and can it move up sequentially?
Very good afternoon, Venkatesh. So yes, mutual fund basis yield is a factor of the growth, that has, been witnessed in the industry. If you would recollect, the previous year that had gone by, the overall industry had grown up north of 32-33%. And in line with that growth has been the market intermediary participation entities such as ourselves, we too have grown. What we always look at is a moderated and an average growth over a series of years and not just an individual year, which tends to gravitate towards near about 20% growth. So if we have seen a 30 plus, 32% plus growth previous year, I think it is only reasonable that a year or so you might see a near about 20%, not a exuberant 30% plus every single year. The basis point yield, is a factor of the telescopic pricing, which is akin to that of any business. Higher the volumes, there is a certain amount of discount that the manufacturer or the outsourcing entity tends to provide and pass back. And we are always very mindful of helping our clients to grow faster than the industry. And it is in that regard that giving any amount of discounts is in terms of improving their market position, which will help us to grow eventually in a which way.
Okay, all right. So the growth coming in is on a higher base, and that's why it looks lower in comparison to the older years as well. You're awaiting regulatory approvals which have to come by for integration with Ascent Fund Services. When is this likely? What will the impact on P&L be once this approval actually comes by?
So about 5 weeks back, we have completed the transaction with Ascent Fund Services. It's a near $150 million transaction to be completed over a 5-year period. We have acquired majority stake. We have already secured all the regulatory approvals in India, which is effectively SEBI, PFRDA, and the RBI. Whilst we have 3 regulators here, given Ascent Fund Services is a global company which has presence in 18 different countries, there are far more number of regulators. The approvals are yet to come from. So in that context, I think we are waiting about 3 different countries, mostly in the Middle East. We expect anything in the next 4 to 6 weeks those approvals to come through. Once that is done, the integration will be completed. From the standpoint of impact on the P&L, the organization is a young organization growing at nearly about 35% year on year on the top line growth. Annualized revenue addition would be roughly about $20 million plus. That is what we would expect to integrate depending upon which month the integration gets completed.
Okay, going forward, will higher growth come in at the expense of more margin pressure? And number 2, what we want to know is that what is the kind of market share that you intend to maintain, given the fact that the growth has been quite strong, especially outside India as well?
So we look at market share, differently from different business lines, right? I mean, so mutual funds is one of our larger business, which gives me about roughly 60% of the market share. Post integration, it will be down, to close to 50%. International business would have then accommodated to be roughly about 25%. Issuer solutions, which is dominantly looking into IPO market and the secondary, market solutioning and services, is about 15%. The remaining is all alternatives, pensions, private retirement schemes, what have you. Our position has been either number 1 or number 2 in every one of these business lines. We obviously intend to become the number 1 in the business lines, where we are number 2 at this point in time. So broadly, we are objectively looking to create the first large global fund administrator based out of India. That's our vision. And that's a 5-year, vision. And I think the acquisition that we have done and our own organic expansion into 5 different countries, into Malaysia, Philippines, Hong Kong, and Singapore, and Thailand, paves way, and provides us the right kind of tailwind that is required for us to achieve that particular goal. Market share, as I said, depending upon which country you move into, we'll have the market share there.
Got that point. Thank you so much for joining in today with the outlook going forward and the details on different aspects of business as well. That's KFin for you. We'll address Shriram Finance's numbers in just a bit, but let's talk about SBI Life because that reported an inline set of earnings with its APE growing and VNB margin 2 expanding 70 basis points. Our colleague Yash caught up with Amit Jingran, who is the MD and CEO of the company and began by asking him about premiums in FY26, growth outlook and the guidance or expectations from APE growth and VNB margin. Listen in.
If you look at our past discussions, whatever we set for the year, healthy growth with healthy margin numbers. I am happy that in the first quarter we have been able to stick to our guidance, and our top line as well as our margins have gone in line with our goals that we set at the start of the financial year. We want a growth which is optimum for everybody. We want an optimum mix of top line and bottom line, and that is what we have been driving through the quarter. Our aim was to have a healthy product mix where ULIPs and non-ULIPs product both are provided to the customer in an optimum way. And during the first quarter, we have been able to drive that kind of product mix with the help of the products that we launched in the last quarter of last financial year and some products in third quarter also, both in non-participating product, participating product and protection products also. So these products have contributed a lot for a healthier product mix, and that had resulted in substantial improvement in our VONB margin also.
Now, if I speak about the numbers, APE for FY25, the previous financial year, was about 9%. The VNB was 7%. When you say healthy growth will continue in FY26 as well, what is the growth that you anticipate?
So during the quarter, we have given a growth in VONB, which is in line with our growth in the top line.
Correct.
And that is what we are looking for the current financial year also. We had projected APE growth in the mid-teens, 13 to 14%, and though the first quarter was a little lower, but that was on a very strong base of the first quarter of last financial year. So I am sure that for the full year, we will stick to our budgeted goal of mid-teens, 13 to 14% growth.
Okay, that is APE, and VNB would be around how much then in that case?
Around the same level.
Around the same levels. Now let me speak to you a little about the product mix. ULIP share, that in the first quarter on a year-on-year basis came down by about 400 basis points when compared. Do you expect ULIP share to pick up in the second quarter and then in H2 as well? And, do you think FY26 will be a year where ULIP again picks up, and could that put some pressure on the margins?
Our product concentration and new product launches are more focused on the non-participating, participating and protection products. In next month, August first half, we are coming out with participating product on the money back lines, and we are also introducing a new product in the mid-range of the protection, that is from 50 lakhs to 2 crore, where the pricing is very competitive and has very good features for the customer. So our aim in the company is to provide a full bouquet of products for the customer. The focus on these non-traditional traditional products, non-ULIP products, has brought down the contribution of ULIP in the first quarter by 400 basis points. This has largely been driven in our agency channel, where the ULIP contribution is now below 60%. There has been improvement in the banca channel also, and where we want to further improve the sales of non-traditional product. So this focus on the product mix will ensure that we stick to our margin range guidance that we have provided of 26 to 28% for the entire financial year also.
Margins could, when you say 26 to 28%, could it be closer to 26 or could it be closer to 28?
It is very difficult to put your finger on any one particular number, because there are seasonal variations also in the sales. So we will be broadly sticking to our guidance of 26 to 28%.
Okay. As far as, what has worked for you in terms of margins also is attaching a lot of riders into products which don't naturally give higher margins. Could that process continue in FY26? And tell us something about the whole process in FY26. How much riders, what is the size of it that you look to do?
So we introduced riders for almost all the products. For ULIPs, it came in the last quarter, I mean the first quarter of this financial year. For other products, it was attached from third quarter and fourth quarter respectively. We are happy to inform that for the first quarter, the rider attachment is 35% approximately across products, and these are now available for ULIPs and non-traditional traditional products also. So going forward, we are aiming for improvement of this 35% to above 50%, and that is providing a good leg up in the margins also.
Okay. One question, as far as you spoke about the margin band between 26 to 28%. What is the impact of surrender value that you are accounting for when it comes to this number of 26 to 28% in FY26?
Our company has been maintaining that surrender value norms, the new surrender value norms, are not going to have major impact on SBI Life's performance. And you have seen that the product pricing, etc., for the new products that were launched post implementation of these guidelines were also not majorly different. So we stick to the statement that we have made, that we were already providing better surrender values in our policies, and therefore there is no major difference in the margins.
One question, as far as bank assurance is concerned, all the worries which emerged at one point of time with statements coming in from the finance minister, from the regulator, reports suggesting that the regulator was looking to put restrictions also on bank assurance. With your conversations after that, are all those worries around bank assurance channel now behind you?
We have been maintaining that the regulator's approach has always been very consultative kind of approach, and we had not formally heard from regulators anything about any restrictions on the banca channel. There were some concerns being reported about mis-selling, especially in the banca channel. Here we are happy to say that the mis-selling ratio for SBI Life is at 0.023%, which is one of the lowest in the industry and almost 1/10 of our nearest competitor. That is because for SBI Life, customer centricity is one of the objectives. We always take very good care of our customers, and we provide solutions as per their needs, as are suitable to their financial goals. So that was the reason that company has been seeing a consistent growth in the banca channel also in last financial year, despite all the murmurs about mis-selling or restrictions.
Well, some very encouraging commentary coming in there from SBI Life, especially doing very well as far as the VNB margin front was concerned. The stock near the day's highest point. Well, even as that particular conversation was being transmitted, you had two important results come about. The first one was Shriram Finance. Remember, this particular stock opened the day on a very negative note, taking a negative read-through from Bajaj Finance results, but post the results largely in line with the CNBC-TV18 poll, that particular stock has rebounded quite sharply off the day's lows. And the other stock, that has just gone ahead and reported its numbers is Chennai Petro. It appears there is a loss as far as the bottom line is concerned. That particular stock has seen a sharp fall in the last 5 minutes to the day's lowest point. But with that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.